Before I get started with anything else, I just want to also give my thanks and congratulations to the New Zealand team at the Commission for Financial Capability. They're, I would say, breaking some rules, changing it up, thinking really quite broadly on some of the things that I'll touch on at the end, which is not just about individual capability, but culture and what's okay to talk about and who do you talk about it with. And as we begin to rethink financial education in terms of not just what people learn in a passive way, but what they actively engage with in terms of products and services and experiences, that we have a lot to learn from New Zealand. So I'm looking forward to sticking around and meeting many of you in the next few hours after this, and I'll be here tomorrow too. So thanks again for inviting me to participate in this conference. I have to say it's the first OECD conference that I've been at, and most of my work for the last almost 20 years has been mainly domestically focused in the United States, despite that early background as an economic anthropologist. So I will also be looking and listening there, and the ways that my own experience is going to come through today will be from what I know best, which is some of the research in the States. But in some ways, I think a lot of this is along a continuum for all of our countries. So what I share today may resonate even if the data itself isn't quite the same as what you were talking about before. Let's go ahead and, I think that's, yeah. Okay, so we'll start with this. The other thing I want to do, and this is the only mention I'll make of the election, Diane, is thank you for the exquisite timing and location of this meeting. Far, far, far away from Washington, D.C., where I usually live. And all I can say is that the late-night reality TV show that was formerly known as the United States of America is something beyond explanation right now. For those of you who don't get to vote in the elections in my country, I can only assure you that I'll do everything I can with my vote, and that we'll work together in the aftermath to figure out how to move forward from this reality TV show. My own line these days is make America sane again. That's all I'm hoping for. From lofty goals to one pithy slogan, that's what we've gotten to. But, you know, I mean, all kidding aside, I think what's happening in America, in my view, really validates, it reinforces the importance of the work that all of us in this room are doing on a daily basis, and that we're here at this meeting to really advance. And that is that, you know, when levels of financial insecurity in households become extreme, it doesn't just destabilize that household and shorten the time horizon people can think in. It destabilizes communities, and it destabilizes countries. And it's destabilizing more than one right now. And the drivers of financial insecurity that we are dealing with go far beyond what we can teach and equip people with on an individual level to some real societal trends and some real global trends. And so we'll talk a little bit about how these interact right now, because if you really want to have an active, engaged today versus tomorrow conversation, we can't really expect the individuals for whom we've shifted a lot of the risk of the economy onto to actually be coping with all of that risk with more information or with a few products. There's actually other parts of the system that we have to be working with to make this go forward. So even though I think in our own thinking, we don't think so grandiosely about the work that we do in financial capability and inclusion, but I really do think that, you know, in the US, we think about this financial well-being metric, and I think Dubis is here from the CFPB. Around these four components, we think about people being able to control their day-to-day and manage, be in control in the short term, be able to be resilient in the face of economic shocks, be on track to reach those long-term goals that they have for themselves and their families, but also be able to take advantage of opportunities and fun in life, and that those are all aspects of financial well-being. The financial capability components of helping people navigate that really is a foundational piece of what makes a strong and resilient society. My charge today is to launch us with some insights, and you know, it was your idea, and you also told me to be provocative, so you know, here we go. But my sense was I was supposed to come and talk to you about how some easy prescription for how do we change the mindsets of people who want it all now, to being able to kind of hold their seat, sit on their hands is my image, and save and invest in their long-term financial well-being and make different choices. But like I said, one of the things we talked about at dinner was the desire to be a little provocative. And for me, speaking authentically, given the option, I'm always going to be provocative over being prescriptive. So in that sense, I don't think I could be prescriptive if I tried on the issue of how do we get people to change their mindset to think long-term versus short-term, because I actually think that besides some of the captions we've seen, there's actually less wiggle room than we think for a lot of people, and it's not really a driving choice that people are choosing always short-term over long-term. In some ways, they really are constrained. So this today versus tomorrow conundrum in our current milieu it has multiple dimensions to it. The big idea I want to put forward, and then we'll move from here for the rest of the day, the big idea I want to put forward is this. Policies that are aimed at generating long-term financial security, I think for a lot of households have become simply irrelevant. They're seemingly too far out of reach to feel possible, so sometimes the pair of shoes or the pot of coffee that you see people buying is because they can't even imagine getting to those long-term goals they might have for themselves. So in order to get more households invested in the behaviors that improve long-term financial well-being, I think ironically, we actually need to focus very urgently on devising ways to shore up households in the short term, something that Martin Luther King once called the fierce urgency of now. And a lot of my work as I moved to Aspen last year, I had been at an NGO for many years that looked at how do you help low-end communities build wealth and build assets. We didn't really focus on retirement. We focused on home ownership, on business ownership, on education. I found that there's a lot of folks who are really kind of moving into this idea of we need short-term savings, and then you have an entire other universe of people looking at long-term savings, and my whole goal would be to help bridge the two by equipping households with the products and services and information they need. So, you know, I don't actually come to this kind of focus, this total focus on now, which is not really the totality of what I look at, but I do think that retirement security and wealth ownership, the kinds of asset holdings that give people choices to make risks. A lot of times we talked about the risk that already comes onto people, but really the ability to take risk comes from a point of stability. And one person said this in a meeting recently to me when it really resonated. It said, you know, they said, I'm able to take risks and I'm able to swing, you know, if moving for my own future was about taking a big swing with a baseball or a cricket bat, I would do all right with that. But of course, I'm not the one standing in a canoe. So there's a lot of people standing in canoes, and in order to be able to be going forward, we need to do more about the things in the short term. I say that because I'm mainly committed to long-term financial security. I'm committed to tomorrow. But I do think that unpacking today a little bit more and some of the trends that got us here is something I want to do now. I'm really struck by the compelling and growing body of research that is revealing more than we've ever known about the financial lives of working families, and the ways that financial uncertainty and that need to manage that risk in the short term is undermining long-term security as a byproduct of that. So my assessment of the situation and the value I place on emerging research stems in large part to the eccentric pathway I took to this work, and I think that Diane talked a little bit about that. I'm a first-generation college goer in my family. I'm first generation that you actually could look at that chart and say I'm doing better than my parents, and I've had good assistance along the way. But getting to college, I didn't have much guidance. I didn't have any preset notions of how to navigate or what to study. And so for better or worse, I became the special project of two professors, an anthropologist and an economist. They taught me to see the world through two very different sets of lenses simultaneously. So I came to all of the things that I think of as the big issues with capital letters on them, markets and economics and politics and risk and inequality and inclusion. But I came to them basically using a bar as my place of field work and talking to individuals and talking to real people about their lives. And it was kind of a backdoor way into these issues and into this career that I've been doing now for 25 years. So the anthropologist in me thinks that looking at things in unconventional ways, looking at things from individual lenses, but also understanding systems really needs to come together. And that maybe the kind of conversations we'll be having today, because I saw there was another economic anthropologist on the agenda, can help us maybe change some of the new narratives we're talking to each other about in terms of what the future of financial capability and financial education need to look like in developed countries and in developing countries. So in terms of the short term here, I'm going to say three main things today. I'm going to talk a little bit about these trends that make me so sure that overcoming the today versus tomorrow challenge requires us to spend more time really grappling with the macro issues that are facing people now and driving their time horizons shorter. I'm going to say a little bit about the solutions, the ideas about how we might focus on building that short-term ground and stability so that people aren't swinging in canoes, so that they can take those risks and they can make the kind of decisions we want them to make through the work that we're doing. And third, I'll close with a different challenge, which I think is for us to think in addition to how we improve individual decision-making, how we really look at this as a cultural change that needs to happen, and not just in one country, but in many places. I love that Diane said right at the beginning, I don't think there's any smokers in here, and if so, go downstairs, and somebody else is going to tell you not to do that. That pervasive social norm and normalization that smoking isn't something that, that really is acceptable in a public place took decades, and it didn't just take individual effort. It took policies, it took regulation, it took lawsuits, it took corporate governance change in corporations. It took a lot of different things, and I think savings is on par with that, that process. So we'll end with kind of talking a little bit about some of the culture change that I think is really on the verge of beginning to happen around these issues. So the trends I want to talk about, two in particular: changing composition of balance sheets and changing nature of work. And I'll do that really briefly, but you know, roughly, I think that you all have seen a lot of this data, but just to keep in mind, there is three different things happening at the same time that is kind of making it harder for people to be resilient in the face of economic shocks. So if that level of, if those financial well-being criteria, being able to manage the day-to-day, and then being able to be resilient with shock, and then being on track to reach your long-term goals, if all of those are pieces of financial well-being, which was what we're trying to get to, some of the trends that are undermining our move in that direction are, and again, this is in the US, but there's some degree of this. This is pre-distribution conversations happening in a lot of countries: stagnant wages, falling wealth, and rising debt for households. So in terms of those data, stagnant wages, this is US data, but in terms of, again, this is the pre-tax experience of a lot of things, and we're hearing this in terms of macroeconomic slowdowns in growth. Really since the 1970s, for the majority of working people, wages have been relatively stagnant, even despite some of the new numbers we've seen coming up. So there's what we called a great decoupling back in the 70s. So the experience of 90% of working Americans has been relatively stagnant wages for the majority on average. So that's one piece of this, is that the buying power has gone down. And then the wealth as well has fallen. So if the broadest shared prosperity that Americans ever experienced was in 1978, around 1978. The bottom 90% of the population, this is Zuckman and Saez's data, and they use the same methodologies that Thomas Piketty did with the global data. But that broadly shared wealth basically was the bottom 90% of households had 35% of all of the wealth in the United States. And you fast forward to 2012, and that same 90% of households had 23% of the wealth. So they experienced a pretty significant decline in terms of the level of asset holding that they had. At the same time that that was happening, debt-to-income ratios in the U.S. Really changed. So a similar time period, in 1983, debt-to-income ratios were about 67%. This is Ed Wolf's looking at our survey of consumer finance data out of the Federal Reserve. You fast forward that to just pre-recession, 2007, when there was a lot of real estate debt. But even so, the debt-to-income ratio at that point was 157%. So at the same time that wealth had gone down significantly, debt-to-income ratios rose from 57% to 157% in that 25-year time span. And so what Ed Wolf and the researchers at the Levy Institute have said is that that actually wasn't fueling excessive luxury consumption. That was fueling basic consumption. So wages were stagnant, costs were rising, people's incomes weren't. Their debt was declining. They were taking on debt to manage the day-to-day expenses that they had, and that's the lived experience that we now see playing out in the kinds of new research we see when the Federal Reserve asks questions now about, do you have $400? If you had a financial shock tomorrow, would you be able to come up with $400? And 46% of Americans say no. So we know that not only is it not retirement savings, that in terms of just basic financial cushion, I think the FINRA research in the US said a similar thing in terms of if you could you find $2,000? And most people, a third of people said no, and that was including borrowing or credit or emergency savings. So the short term is looking rather dire. And that's one piece of it. I think that the piece to bring along with that trend of stagnant wages, rising debt, and debt's settled out a little bit, and it's changing some, right? Now we're dealing with education debt, and I know that in New Zealand, that's a big issue as well, is education debt and how people are thinking about that and financing their futures, and how that aspiration gets tied to debt instead of aspiration getting tied to setting yourself for success. The other piece of this that I think it's important to keep in mind is that it's not just that these big trends are going on in the background, it's that the actual nature of work is changing, and at least it's changing a lot in the US. And I think, again, talking to folks in preparation for this conversation, it's not just a United States trend, it's also happening here, it's happening in Australia, there's a lot of different trends here. Here I really want to talk about contingent work, contractual work, and the rise of income volatility. So, you know, what I want to say here is we've seen this stagnation idea, this idea that wages have been stagnant, but this annual data, this aggregate annual data actually masks a whole lot more than it reveals in some ways, because underneath, if you peel away that idea that wages are stagnant, you think of stagnant, you think of no motion, you think of things being the same. It doesn't actually say that people aren't stable. It just says that wages aren't changing. But the new financial diaries research that I know it's been happening in many places around the world, but in the US, the financial diaries has been a really interesting set of research into about 250 households across the country, looking at their day-to-day cash flows. And what that revealed, and JP Chase Institute has recently come out with information as well, is that not only was income volatility in an annual cycle growing over this same time period, Karen Dinan, who's Undersecretary of Treasury for the US, in her work about 7 years ago, first documented that income volatility had grown about 30% year over year. Year-over-year income volatility for households had grown about 30% over that last 20-year period. But what we never knew about was month-to-month volatility or week-to-week volatility. And what we're seeing now is that, at least in the diaries and in the JP Chase work, month-to-month income variation can be 30%, 25 to 40% volatility month-to-month in terms of that. The drivers of that volatility are a couple of things. On the one hand, more and more people are going to contingent work, to contractual work, what people in the US are calling in some ways the gig economy, although that's still small. There is some research by Card and Kruger that came out that showed that almost all new net jobs in the United States have been contingent jobs in the last few years. And the percentage growth of this experience of work is that this is the highest type of growth. So there is a rise of contingent work, there is a rise in part-time work, and there's also a big rise in within-job volatility of hours, because as we've moved to algorithms setting schedules for individuals versus managers setting schedules, and you can do it for a whole chain of stores versus one store, people's ability to manage their own schedules and their own time have changed, and so it actually crowds out your ability to have a second job. It crowds out your ability to think about childcare if you're getting your schedule a day or two before, and you're not able to figure out how to muster the resources to manage that process. You can't also, there's also a lot of indication that it's keeping people from going back to school because again, they don't know when they're going to be working. They want to work just like they want to save, and they're finding it harder in this space. So it's a big growing trend in that space as well. And then piling onto that, it's not just that it's contingent, it means that there's a lot of fewer associated benefits, including retirement, going on with this work as well. So people aren't, not only if they don't know about it, they're not paying into our Pillar 1 system, Social Security, because that's a payroll tax in the US, but they're not saving for their own retirement in an involuntary way, and they don't have access to retirement savings plans at work. So really what ends up happening with this is that, as you can imagine, the way that the short-term issues begin to crowd out some of the ability to think and make long-term plans is there. I do think that there's still the shoes going on and people wanting to buy shoes, and there's certainly, I was just running a wonderful dialogue with a set of youth in Aspen, I think 4 days ago, not too very long ago. And one of them was talking about her first inklings of savings where she wanted to save for that pair of sneakers. She wanted to save for the pair of sneakers. But once she did that, she set a longer-term goal. And once she did that, the future became possible for her. And so it was very much this layering on of individual agency, setting goals, somebody helping them navigate, giving them the right products, and waiting for them to have their aha moment about it. I think that's the power of the individual work, but I think it has to be coupled with what we understand about the broader systemic changes that are happening. So what I'm saying in terms of solutions is that in order to get to later, we really do have to focus on now. And we have to think about a new kind of, in the US, does anybody else use the three-legged stool terminology in their countries about what it takes to create financial stability? So in retirement, the three legs were you have your Pillar 1 savings system, you have your work-based pension program, and you have personal savings. In order to even get to that possibility, for that to be the aspiration that people think is possible, my solution is that we actually need a step-up stool. We need a three-legged stool that is all about getting people liquidity so that they can get to security and stability. So what I mean by that in terms of some of the solutions now, and I think this fits really well into the financial capability work because you're not just working in the domain of savings, you're working in the domain of people's balance sheets and choices and helping them navigate those choices and be better off tomorrow than they are today. So the three pieces of a stool that I would see in terms of short-term work is emergency savings, and finding, ideally, we'll talk about this, not just ways to just do it separately, but to hook it into the retirement system so that people are saving and mentally accounting, but having what they need in all of those facets. I think it also means looking at small dollar credit and looking at it carefully in terms of when credit and debt puts you in a better place 5 years down the road and when it doesn't, and giving people the right tools to navigate those decisions. And also insurance and benefits. And from this, I don't mean just social insurance, although certainly in the US, the social contract itself is part of what it almost comes out of the realm of financial stability and financial capability at that point. There's other parts of our world. There's rethinking how labor markets work, not just financial markets, that has to be done in tandem with people working together. And so there's work going on with all three of those aspects. In terms of emergency savings, I can say a couple of things that are really exciting. We have the financial diaries work that I talked about found that most low-income households and most households in general did save, but they saved in their checking account, and they saved for soon. They didn't save for long-term. They were saving for soon. So at any given time, you might see money in their account, but that money was already earmarked for some use that was later that month or later that year. And so savings itself actually is alive and well, the idea of it, with a much larger population than we would think. But what the things are that they need to save for and how many things they can save for at once still seems to be limited by some of the ways that both their finances are constrained and other pieces. In the US, we've also had a lot of work on prize-linked savings, but the one thing I'd say here that we're really excited about is as some of the new innovations on retirement savings begin to happen at the state level, California last week just passed a new Secure Choice Act. And California, it's fun just to size that market. California just passed the UK as the 5th largest economy in the world. And by passing Secure Choice, the legislation says that every employer with 5 employees or more has to offer retirement savings to its employees, and those employees can opt out, but it has to be offered. And we already know when you set defaults that the opt-out rates can be quite low. In the UK with Nest, they're quite low. It's an IRA. It's going to be a default safe account. They're working out the logistics of it now. But this is going to be savings opportunity, automatic, at the workplace for 7 million Americans in the next couple of years. And there's going to be a lot to get right and a lot of ways we could get it wrong. But that is one of 5 states that's passed legislation. There's now been 3 cities that have decided to take this into their hands because, once again, they're recognizing that this long-term financial security issue of households will have a really big bottom line impact on their own budgets at the state and local level. And since the federal government isn't acting, they're acting anyway. One of the most exciting things in that domain is to create what we're calling sidecar savings accounts, which is a split account when you're automatically saving so that part of it builds a liquidity fund and part of it goes toward your retirement fund. And once you hit that retirement, that liquidity idea, the rest of it starts going into your retirement savings account. So a behavioral economist, David Laibson and Bridget Madrian, are working on this idea. 2 of the treasurers at the state level are really interested in this idea, and we're helping to think about everything we can to promote and experiment with that process. Because we also know that long-term savings is at risk when people have short-term crises and they use it. And in the US, we have a quite porous ability to pull from retirement savings. They call it leakage, I call it usage. But people have emergencies, they draw from that funding. And if they had a savings account, they would be able to deal with that in a different way. In terms of small dollar credit, there's a lot here about alternative data reporting, access to credit, what we call credit invisibles in the United States, which is so many people who don't have a formal credit report and the need to deal with that, not just so that they have access to credit, but increasingly credit reports where we are also have to do with being able to be employed or find housing, because people use those to assess your character and your ability to do many more things than repay. There's also legislation in terms of, I heard you talk about some of the regulatory pieces before, the ability to actually ban the use of credit reports from being used for those aspects, but that is still a work in progress. And then the last thing I'll mention is social insurance and portable benefits. And so I think that there's a lot of opportunity for innovation here. This is one of those that's been the hardest in terms of financial education. Because short-term credit and short-term ideas around insurance just are hard for people to get their heads around. Renters insurance, any kind of ways to kind of not have to self-insure with savings, but what are some of the shocks that are inevitably going to happen at some point that you could handle with a different kind of product? And what is the information that we provide, and what is the quality of those products and the consumer protections around those products? And I think that's a whole new horizon for people to look at. So in that sense, that's the short-term pieces. I do think that in connection with those short-term pieces, we, like many other countries, still have to rethink retirement savings and retirement social contracts. But linking them together overall is a really important part of what we've been focused on trying to do and understanding what's really going to work for people and what's going to resonate with them as the stepping stones that lead them to their broader financial security issues. I did say that in terms of the closing piece, I wanted to spend a little bit of time instead on culture. I actually think that one of the things that we forget when we talk about financial capability and financial decision-making and behavioral economics so much is the wider cultural context for any of those decisions that are happening. And we talked about it a little bit with the smoking. But I think that there's more ways to think about this. I think that there's ways that you can look at obesity epidemics as being very similar in terms of what do we actually have to do around changing the systems and the culture and not just the information, so that different choices are not just possible, but different choices are becoming normalized. And one quote I'll share, there's a term with obesity research called an obesogenic environment. And that basically means that there is a whole lot of just markers out there, right, for you to be constantly bombarded with food at the checkout counters and with restaurants everywhere that are open all hours and takeout and things like that. So we've created an environment that really facilitates overeating. And I'm thinking that there's a very parallel piece here where we've created an environment that really facilitates overspending. And so I don't know if it's called a debtogenic environment, and there actually is a couple of human geographers using that term and looking at doing spatial studies of that in the UK right now. But this idea that we have made it so easy, and we look at the financialization of our world, and it's so easy to spend. It's like the Eskimos having 18 words for snow and none for other things. I think we have 1,000 words for spending. We have a very few for saving. And so there's a lot of ways to have to change the environment to actually make it as easy to spend, as easy to save as it is to spend. I have an app on my phone called Digit. Has anybody heard of Digit? This is one place. I'm interested in all of the financial innovation work going on. I think especially in the US, innovation does not necessarily lead to greater inclusion. And so there's been a lot of people solving problems for people who aren't really having problems, and not a lot of time being spent solving problems for people who really are trying to figure out how to make ends meet throughout the year. But Digit is an app that I'm finding really interesting. It's on my phone now, and it basically follows along. It follows along with you like your friend, and it looks at your spending patterns. And it takes money out of your account and puts it in a separate bank account that's really hard to find. It's insured, it's separate, but it engages with you every day. Every morning, Digit wakes me up. It tells me how much money's in my account. It tells me what my recent transactions are. It very rarely tells me how much I've saved. It doesn't really tell me. And it very much carefully makes sure that it doesn't create overdraft opportunities for me. And if I actually want to find out how much I've saved or how to go find it, I have to go way back to the first email. But sure enough, it is something that's happening behind the scenes. I'm not making decisions. It's going to be totally okay even if I have a volatile income, because if I don't have money coming in and my spending patterns it's following those, it's not going to take money out. So I do think that there's ways that we need to get smarter with how we look at monthly withdrawals and things like that, and I think financial technology can help with that in some ways. But beyond that, I just want to close with this idea that it's beyond individual decision-making. And this is from these human geographers that have created the word a debtogenic environment. An obsession with individual behavior reframes social problems as issues of psychological pathology. In this sense, it is an unambitious political project that has little to say about government's role in reducing wider social inequalities. So I would encourage us as we go forward to think not only about the individual behaviors that we need to reframe and the arguments that may convince people to do things differently, but in the end, we really should be also looking at a broader social and cultural context that as it changes, it would just be so great if that mindset, I'm not trying to be nostalgic, but I was struck by how we started this morning. I was struck by populations in our own societies that haven't forgotten how to think in parallel about yesterday, today, and tomorrow. And we've made that very hard to do financially for people. But we've created the problems and we can fix them. And this is certainly a room full of fixers. So thank you for the opportunity to talk to you, and I look forward to today's conversation. Thank you. Yeah, I have time for questions if there's.
I was just saying, we've probably got 5 minutes, guys, so we can go to the floor and take maybe a couple of questions. Can I just ask that it's a question, not a long rambling statement.
Like mine, which is, you know.
No. And we've got mics all around. Right, I can see someone. Oh, we've got two.
Great.
Just in the middle here. Dave, you go first and then we'll...
Thank you very much for the presentation. I just had a question about the broad ethnic mix that makes up the American population today, and are you aware of any distinct differences in terms of preparation for retirement, particularly amongst new immigrants versus those that have been in the States for a long period of time, or even ethnicities in general?
Yeah. So you could make the hypothesis and test it very easily. African American, Latino, and immigrant populations have very low levels of retirement savings. In terms of African Americans, so there is a way sometimes that they also have much higher leakage out of their retirement savings, and part of the assumptions around that are that if you end up with one member of your family, if you're the one person in your network with a savings device, that also becomes a highly needed remedy for many problems. And whereas that might be diffused across multiple people, managing those shocks in families where more people have retirement savings, in African American families it's not. The actual wealth gaps, and I've looked up the wealth gaps in New Zealand as well. In the US, it's about $10 to $15 of savings that white-headed households have to African-American headed households. And for single-headed households with kids, the median net worth for African-American single-headed households with kids is 0. So we are extremely unequal in that sense. Part of that's the sectors that people work in, parts that's the quality of the jobs. Especially in California, I would say that this new secure choice piece, almost 70% of the employees, it's also small businesses, right, that don't have retirement savings, almost 70% of the people who it is estimated this will start to help will be women and people of color in California.
And Cheryl from Brazil?
Yeah.
Well, thank you very much, Ida. Since you have some extra time, would you mind elaborating on that slide of yours that would speak about later?
Oh, about the later piece. So later, of course, I was focusing on now pieces, doesn't matter. So in the US, the 3 pieces of later for us are Social Security, which is our Pillar 1 system. It's a pay-as-you-go system. It is not solvent, super far into the future. And right now we're dealing with huge baby boomer retirements, right? So that's definitely something to shore up. There is workplace savings. Currently, less than 50% of employers in America offer retirement savings. And so these new automatic enrollment plans would help to shore up that. But it currently, in terms of workplace savings and pensions, and what Andre talked about is we've moved to a defined contribution world. More than a third of all American workers have no retirement savings at all. Another third have less than $100,000 in those funds. So if the Pillar 1 saving system isn't working particularly well, and the level of, they're calling it the silver tsunami, right? This piece is really moving. I think the other part is personal assets, home ownership. Can people sell? There's a lot of innovation happening around reverse mortgages and looking at if there's innovation and consumer protection around those pieces as another way to do things. And there is a lot of work. We'll be starting this year an Aspen Leadership Forum on retirement savings to begin to really help to create a much more inclusive, comprehensive federal, savings system, much more like a Kiwi Saver. There's Nest, there's Kiwi, there's many different countries that we're trying to learn from as well right now. So not only is it's dire for people who can't even think about retirement, for those who have thought about retirement, the options and the strength of their ability to retire with dignity is really quite scary at the moment.
I've just got one
Yeah.
from Elsa Fanero.
Hi, Elsa.
You started by connecting somehow uncertainty and wealth and income distribution. And this takes me to wonder how much of your analysis could be valid also for Europe.
Oh, very much so.
Yeah, why? Because, well, Europe is still in a depression, let's say, many countries. And it's true that many governments are now talking of encouraging consumption. So your view would be relative to some groups, in particularly exactly those groups who are mostly hit by uncertainty. And those are exactly the young in Europe, because it's on the young that precarious jobs are concentrating. So their problem is not so much lack of savings, it's lack of income. Mm-hmm. And the older generation who have relatively generous, let's say, social protection scheme can save and do save exactly because of uncertainty about the young generation. So it's a vicious circle, and it's very difficult just to say, okay, we have to encourage people to save more. Because today is very difficult, and today we'll need in Europe more consumption than just more savings. Right.
So I mean, I think it's a great analysis that you've just given out. When I first came back to Aspen, we had a lot going on with retirement savings, and one of the new things I created is called EPIC, the Expanding Prosperity Impact Collaborative, where we look at one issue each year in depth with a lot of experts and try to figure out what we collectively know about the evidence base of a problem and a solution set that would make sense for that. Income volatility was the issue we've been looking at this year. It's certainly, research suggests that that's not just happening in the US, that income volatility and work precarity is happening across many, many countries. So our solution set doesn't stay within it breaks a lot of silos. It doesn't stay within the realm of what can be done to help people manage their scarcity. I don't think that's the solution any of us are looking for. You know, I don't think the whole point of what we're trying to do is to make it less expensive to be poor, and I don't think the whole point is to help people manage scarcity. So when there is a savings opportunities and when savings systems can be in place and robust, we should do that. We should also realize that that's not going to be enough. And so conversations about wage insurance, and basic income, and guaranteed jobs, and other ways, because we know that work provides dignity, are also being talked about in the United States. And there's a whole different part of what we're doing right now, which is trying to connect the people who are focusing on how do you help people navigate labor markets to those of us who are working really first and foremost, how do you navigate financial markets and financial decisions. Ideally, these things become organically tied together. Right now, those are quite separate conversations that there's a lot of work to be done ahead.
Great.
Thank you.
Join me in thanking Mike.
Thank you so much.